Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you stay ahead. On April 18th and 19th, Fidelity Investments Canada hosted Focus 2024, a two-day event for advisors featuring insights from Fidelity's portfolio managers and subject matter experts. Today, we'll hear from portfolio manager Dan Dupont as he sits down with host Agnes Doherty at Focus. Dan, a Fidelity veteran who joined the company in 2001, manages or is underlying manager of several Fidelity funds for Canadian investors. This includes Fidelity Canadian Large Cap Fund, Global Value Long Short, Northstar, among others. Dan is known for his downside protection approach of winning by not losing. And in today's conversation, he shares why the current market environment is favorable for him and matches his investment style. This podcast was recorded on April 18th, 2024. And today's podcast is brought to you by the 2024 Fidelity Retirement Report. Head to go.fidelity.ca/retirement to receive the report and insights on how you can better prepare for your retirement, whatever that may look like.
All right.
All right.
Hi, Dan. Welcome to Beverly Hills.
Thank you. Welcome to Beverly Hills.
That was quite an impressive resume that you have. Congratulations on
You.
such an incredible career so far at Fidelity.
There's ups and downs. There's cycles. So we'll see. We'll see what the next 5 years bring.
So as always, there's never a dull moment in the market. And so I thought we could start off just by talking about sort of your perfect environment for investing. What does that look like to you, and sort of how does it look relative to the market currently?
Yeah, I'd say the current environment is pretty close to what's perfect for me. If you asked me over the last 15, 20 years, what would you like to have as a setup for your process to be kind of the place to move a bit more money? I'd say, well, we need an environment where we haven't had a recession in a long, long time. People don't believe there's going to be a recession for a while. The yield curve has been inverted for a long, long time. It's been 18 months now. Profit margins are high. Valuations are not cheap. And there's a lot of divergence in the market, meaning some stocks are really expensive, some are really cheap. If I could have a cherry on top, I would say, well, bring in a lot of growth, a lot of momentum in the more growthy area, which means there's been momentum down in a lot of more value-oriented areas, more cheap areas. So, we're pretty close to that right now. So I am quite, busy doing some movement in my funds, and the cash positions are actually coming down, which is weird because the market's been going up. I mean, the S&P's been kind of the train that's been going a little faster than everything else, technology specifically. But outside of that, because of the convergence in performance inside of a few really specific areas, there's been pretty interesting opportunities that have fallen to the levels that are interesting for me. So it's been interesting to see them, on weeks and months where the market's just steadily going up, seeing these opportunities appear and using cash to deploy in areas that are now interesting.
Just as sort of like a general comment, what are your thoughts on the concentration in the market? And we've obviously seen a lot of hype around AI stocks. I know those are not really the companies that you would look to invest in, but what's your sort of general comments on what's playing out there right now?
They might be a place where I look to short, potentially.
Yeah.
So, I try to see where the top kind of macro view of what we're seeing is aligned with what we're seeing on a bottom-up perspective. You've heard all about how many notes we write every day from the analyst pool and all the information we get from the ground. So what I'm seeing when I read these notes is there's some pretty easy theme to pick up quickly that are pretty obvious. So concentration in very specific areas, not like we saw 2-3 years ago. There's a few less areas now, but most, technology obviously, and the U.S. from a geographic perspective is significantly more expensive than a lot of other places. So geographically, I'd say the U.S. is back to where it was around 2000. It's the area where everybody wants to be, you might bring this up this afternoon as well, but we were reminiscing last week about how impossible it was to get clients, ultimate clients, to diversify outside of Canada in 2012, 11, 13, that time frame, because Canada had been doing so well, commodities were doing so well. And so MSCI World is now, 70% US, very US-centric. It's the time, in my view, to look at places that are more interesting, cheaper, and they kind of pop up when you read the research. So the UK is very cheap. Japan has some interesting ideas. South Korea has some interesting ideas. And then developed markets generally, Europe, if you really do your work, you can find some really interesting ones. And Canada's kind of in between. We have some interesting places. We have some more worrying areas. So that's kind of the overall view. I was thinking, a year and a half back when, as I run a long-short fund as well, so I do have to look at the extremes of the market. And I was thinking, are we really going to see again kind of an echo bubble of what we saw? Because that's what happened in 98 and 2000, right? 98, tech was really, really strong. Small cap was in the gutter. And then Russia defaulted. And, Asian tigers were in trouble. And eventually everything came back somewhat. And it came right back in the same areas, which was large cap tech. And a lot of people lost a lot of money around that time because it seemed obvious to them that the bubble was over. It just came roaring back. And then the same happened with the Chinese commodities era of 08, where everything kind of, we were all thinking, well, it's impossible for China to decouple from the US. And then, in fact, that's what happened. And then all of a sudden, it all came roaring back. Everything in commodities land came back in 11, 12, 13. And so I looked back, at the end of 2022, and I thought, well, I guess this could happen again. Obviously, in my mind, it was going to be difficult because rates are now normalized. Rates are they're kind of they're the brakes on the train. And for a bunch of different reasons, they seem to be working a little less well this time. So a lot of stuff came roaring back. Some didn't. Electrification of transportation is kind of the prime example there, where there were so many new electric car companies, so many themes around that, lithium, copper, and ultimately, I think now people are realizing it's going to take a while for that to really come to the promised land that we see, which is kind of what happened with the internet and metaverse, and now we have AI, which my guess would be it's going to be kind of this. It's going to be really difficult to figure out who makes money with this new technology and how, and we might need to go through a corrective phase. And same with cryptocurrencies. That's another area that has come roaring back, and we'll see where that ends up.
Well, you touched on a lot of things there, and we're going to dive deeper into some of those topics as we go along. But just for everyone in the audience, please do enter any questions that you have on the app, and we'll be sure to get to those. Andrew Marchese made a comment this morning that complacency builds on consensus, and I thought that was a really good line. And he also talked about there's a lot of debate internally at Fidelity about sort of the spectrum of outcomes. And so I'm curious to know what, in your opinion, are investors not thinking about? Like, what could go wrong here?
I think I'm feeling pretty old sometimes when I look at what's happening in markets and when I talk with our analysts, because we haven't had a recession in a long time, but also we've had a really strong growth market and recently a really strong momentum market. And so it's always true that price drives narrative. So wherever the market goes, people start talking about how this is actually happening for a good reason. And I'd say we have to be careful about trying to step away from these areas. At least on my process, I need to stay away from making the big mistakes of the day. And so right now, to me, that's pretty obvious. There's areas that are less obvious. So obviously, the stuff that's really expensive, AI, cryptocurrency, software. There's some areas there where I know enough to short. There's some areas that I don't know enough, but they're all too expensive. And then on the flip side, there's areas that are really, really, really cheap that have been forgotten. And one example of that for me is basically the cheapest industry in the world is tobacco. Tobacco is always cheaper than the rest, but it's always interesting to me to have discussions with people who think they know the industry, they think they know what's happened over the last 25, 30 years. I saw a good graph recently on tobacco versus S&P technology over 30 years, and tobacco's been pretty much the best performing sector over 30 years, and even recently. And technology has spiked up to catch up with tobacco twice. Once was in 2000, and another time is 2021, 2024. So that's kind of interesting to me. And then when you look at the stocks themselves, everybody who hasn't looked at the numbers assumes that sales are going down, volume's going down, obviously 5, 6, 7% a year. But if you can price whatever you're selling 10, 12% more every year, and it's still a pretty small percentage of discretionary income, certainly the case in developed markets, then your sales are going up, your cost of goods sold is going way down, the units of production you need to do whatever you need to do is they're going down in value. Your requirement is going down every year. So the end result is a bunch of those are trading between 5 and 7 times earnings. The two that I own in the UK are 5 and 6 times earnings. And they have a 17, 18% free cash flow yield, 2 turns of debt, 9%, 10% dividend yields, and sales are going up. And there's innovation in the industry, which I need to stay ahead of, but as long as I feel comfortable that this is going to be fine, versus a 5% rate you can get in the market, to me, that's pretty good. What should be shocking to people is at the other end of the spectrum, we've had rates going up, and whatever is long duration hasn't really corrected. It corrected in 2022, but it's come roaring back. And it seems like we're all kind of just assuming that it has no impact on long duration equities, which include a lot of these really tough to value companies with very little revenue and a lot of prospects. They're the new Brazil, right? Brazil is the country of the future and always will be. Some of these companies, they're kind of like they're always promising things are going to happen soon.
And you've owned those tobacco companies for quite a while in the portfolio. I feel like they've been in the top 10 for a number of years.
Yeah, to me, quite a while. 4 or 5 years. To me, that's not that long. I mean, when they get too expensive and there's something better to do, we'll go there. It hasn't been the case since I got into a bit more heavily into tobacco 4 or 5 years ago. But the narrative seems to move in waves, and eventually they'll get back. They'll be a bit more forgotten. The multiples will go back up a little bit, and maybe there's going to be something better to buy. But right now, to me, that's one interesting place to be. And it's boring. It's me. That's what I do, right? It's protecting capital, and I think they're going to be pretty good for us. Are
they diversifying their product shelf at all?
They are. I mean, there's obviously we could spend a lot of time on this. There's heat not burn. There's vapes, obviously, and the whole technology around vapes. There's new vapes that are way better, where it doesn't really burn the whole cylinder, based on how the burner is made. But in general, there's 4 or 5 companies left in the world, and they're all kind of innovating. And when you have so few companies, and the other thing is also, in very simple terms, if you try to start a new tobacco company, how are you going to advertise? Yeah. You're not allowed to have your name on the product. You're not even allowed to even display your product. So, when governments came up with that, Philip Morris was like, okay, so no competition, I guess. All right, let's go.
Keep raising the prices. So I was actually listening to you on a podcast. So for everyone in the audience, we have our own TV show. It's 11:30 every day, Fidelity Connects. And if you can't watch the live show, you can always listen to the podcast, the replay, which I do all the time in my car and on a flight to LA. So I was listening to your most recent one. And
really had nothing else to do.
It was a boring flight, yeah. So. But you were talking about you're starting to invest in some of the forgotten parts of the market that look attractive. So tobacco being one. Yep. Give us some insight into what some of those other areas are. And this is, I think, for this positioning, we'll sort of highlight that it's a little bit more Canadian large cap focus.
Yep.
Okay.
Yeah. Well, I talked a bit about utilities over the last 6 to 9 months. I'd say the market is moving quickly. We can't talk about what we do every day, but I would say generally in the last few weeks, the market has aggressively repriced against what is interest rate sensitive because rates seems to be stubbornly staying high. And so in general, telcos have been really pummeled. There seems to be a lot of nervous people around the industry. So, I mean, it does take a lot of great research because there's a new entrant in the industry. And are we going from a 3 to 4 player market? How is it really evolving? Is the pricing becoming way more competitive? Is that going to punish profitability? So all things we need to analyze. But on top of that, the interest rate sensitivity of that group has certainly made them very vulnerable recently. So that's kind of an interesting area to dig into to see if you want to add there. In general, I think as a group, I assume that's what you'll get out of the next 2 days is that we are not super bullish on the Canadian consumer because the Canadian consumer is very indebted. And so how does that translate into stocks is kind of the really important answer over the next 2-3 years. I've always been underweight Canadian banks, or practically always. And right now I'm around 2% weight. And I think in general, the group is a bit underweight. We're a bit nervous about how such a levered entity to what is extremely indebted in Canada is going to perform over the next 2-3 years. So that's what's interesting to me. It's more kind of the interest rate sensitive, but a bit less cyclical and hopefully a bit less impacted by the movement in indebtedness of the consumer. Although you could argue, when there's a recession, telcos do suffer a little bit as well. I already own a lot of staples and moving around the areas where there's more interesting ones. I think Ramona talked about Metro and Couche-Tard this morning. Those are 2 of my holdings as well. But there's ways to increase or decrease your holdings or play other areas in the market. But in Canada, I'd say that's the obvious ones. The other area that is going to be discussed maybe a little bit is commodities. Mm-hmm. And so to me, that's a tough one because we could be in like inning 5, which is 6. It's an area that's tough for me to play when we get there. It was easier in 2020. It was actually very straightforward for me. In 2020, a lot of these companies were trading below replacement value, below book value, and they're hard asset companies, so book value matters a bit more than in other areas. And so, for my process, the fact that, CNQ is up 5-fold and Tech Cominco is up 6-fold since the fall of 2020, and they're all trading, CNQ's basically 3 times book value, it could still work. It's a calculus that is a bit farther from my process because you need to have really companies that are mature and will not compete too much on supply, which for now seems to be the case. And you need demand not to falter too much, which in the last month everybody seems to believe is fine. There's not going to be a recession in the next 2 years. So that's the toughest part for me there. So I'm not really shorting anything in commodities, but I'm certainly a bit more cold at the idea of putting on a decent position in my long side.
So just sticking with commodities. So if you think of commodities, you've got sort of like oil, as you mentioned, or base metals. Gold has obviously been rallying year to date. Maybe I'll ask you the question, if you had to choose between gold or Bitcoin, which one would you choose? Knowing the answer already.
I'm a bit old, so maybe I choose gold. No, I find it fascinating having discussions with our younger analysts about cryptocurrencies, and it's fun because I'm hearing all the arguments, and they're saying, well, cryptocurrency, like a Bitcoin, there's limited supply. Okay, wow, I love that. It's like gold, but there's even less supply coming. Love it. Well, it's a way to get out of kind of the inflation created by the government. Okay, it's an alternative to cash. Yeah, I love it. Makes all the sense in the world. And then, you get to the point where how do you value it and how does it trade? And you look at, well, how does it trade? It's basically 100% correlated with a triple levered NASDAQ ETF. So I hear you that maybe 5 years from now, Bitcoin will be the new gold. But right now, it's not trading at all like what gold is, which in my view, because I don't know much, but I ran a gold fund for 4 years. So to me, what makes sense is kind of in a box. It's kind of an alternative to the US dollar. It's, it trades relative to real rates in the US, so all of that makes sense, right? But Bitcoin's it's not there yet. And so how do you value it? That's a really tough one for me. I'd stick with gold right now because it's analyzable in terms of value, but we'll see what the future brings. But the trading around it certainly makes it kind of interesting, right? I mean, I'm not that smart, so I have some really fast and simple rules in investing. One thing that tells you an area is really speculative is when the stocks related to that area are trading at really, really high volume every day. And a rule of thumb is if it trades all of its float under 10 days, it's just a speculation. People are just speculating. They have no idea what they're doing. And it could go all over the place, could be down 50%, up 100%. And frankly, in 2021, that happened a lot with stocks that were related to cryptocurrencies, and it's happening again. Shockingly, I guess, to me, and maybe not to other people, but and as long as that's happening, I don't think we're getting what we're supposed to in terms of signal from what's the underlying.
You're really making me question my RSP contribution into Fidelity's Bitcoin ETF, so I might have to review that. So you made an interesting comment about Brazil. Sort of, people are always talking about how it's going to be sort of the next big thing, and I kind of feel something similar around China. For a number of years, we keep hearing China's undervalued, China's really cheap, and obviously, valuation is a relative measure. But what's your thoughts on China, and is that an area that you've been looking at investing more in?
Yeah, I wouldn't say it's been cheap for many years. I think in general, we forget how things really, really swing around. Max Adelson, one of our analysts, was telling the sales team internally a few weeks ago that he remembered when Max Lemieux, Hugo, and I went to university to speak to them. And there were many speakers that day, and he remembers vividly that he was shocked at how different we were discussing the markets. So everybody was talking about China, commodities, the growth of emerging markets. And we got there, and we said, forget about everything you think you know, like you're all investing in commodities, you guys are all wrong. The next place is absolutely not there. We're not sure, but there's a lot of cheapness outside of that. And he remembered that, and I don't remember saying that, but yeah, that sounds about right. I'd say now we're the exact opposite of that. And it's actually been pretty quick. I wouldn't say China was cheap a year ago or a year and a half ago. And so I was always staying away from whatever was impacting commodities and emerging markets to a really large extent until very recently. And I had these arguments, and people would come up to me after my presentations at Due Deals and say, in 2012, 13, 14, saying, I love your presentation, but I don't invest with you because you don't do enough in emerging markets. I'm in emerging markets because that's where the growth is. And I would basically retort the argument, which I think kills their whole thesis, which is there's no correlation whatsoever between GDP growth in a country and stock market returns. And 2 minutes later, that same person would say, yeah, no, I hear you, but I'm investing in emerging markets. Okay, great. As I said earlier, price drives narratives, right? And right now, the Chinese stock market is going down every day. Oh, well, it's because real estate there is going really, really badly. Frankly, it's tough, but it's not the end of the world. You read the notes, and at retail, people are spending, they're buying cars. And yeah, the banks over there are going to do what the European banks have done for the last 10 years. They're going to earn $1 billion a year, and then they're going to write off $1 billion of real estate. And they're going to keep doing that every single year until they're not a zombie anymore. But outside of that, it should be okay, and the stocks are so cheap that I've started buying a few positions there. So in large cap, it's practically 5%. In my global funds, it's around 10%.
Can you get a little bit more specific about sector or companies that you like there?
Honestly, Patrice will be a bit more esoteric, and he obviously knows a little bit more than I do because he works way harder. But I'd say there's cheapness in large caps, And so why go elsewhere? If Alibaba's trading at 8 times earnings, net cash on the balance sheet, buying back shares, growing, double digits, why would I look elsewhere? It's super liquid. Or, Tencent you can buy through like a company in Europe, which owns shares in a company in South Africa, which owns shares in Tencent. And so you get a massive double discount, which is pretty wide right now. So maybe you'll get the benefit of one of those shrinking or one of those disappearing. So there's all kinds of interesting ways. But overall, I think these are the cheap places in the world. It's China, the UK, and at the other end of the spectrum, it's tech, US. Anything tech related in Asia is pretty expensive, and India as a country for some reason is egregiously overpriced. I mean, every piece of research that I read is just everything's between 40 and 75 times earnings.
So you do also run your global value long short strategy for us. So I thought that we could maybe pivot the conversation to that fund. So it's a liquid alternative strategy. Maybe you can give us a little bit of an update on that and sort of on the theme of egregiously overvalued parts of the market. Where are those areas for you right now? Where are you shorting?
Well, very simply, like I said earlier, there's less of them out there, but I try not to be too concentrated there. Obviously, big parts of tech. So in 2021, it was a bit more fish in a barrel, but it's still pretty bad. And as I said earlier, I've been wrong. I really didn't think that some of these stocks, like Dave said earlier, some of these fundamentals haven't changed, and some of these stocks are up 5, 8, 10-fold. It's so when do you short? Do you short when it's up 6-fold or 8-fold or 10-fold? So that's the tough part, and it's even tougher for you as a client because you don't know what I'm doing every day. I get excited because I see what's going on, and what you see is, well, the fund's down today. Well, to me, there's more and more opportunities, and because of the momentum, which has created these massive discrepancies, I have never seen in any of my funds a better opportunity for alpha over the next 3 years, because both the long and short side are at extremes. Right now, the short side is not as exciting as it was in 2021, 2022-ish, but it's pretty close. The long side is way more exciting because there's more opportunities that got to a price that's interesting to me. They're completely discarded, hated, and disregarded. So, we've put on some. They're frustrating because some of them just, they stay there or they stay on their momentum trail, but the fundamentals are there, the valuation's there, the dividend's there, the balance sheet's there. It's just a matter of time. And that's why, I assume we want to talk about Global Equity Plus a little bit.
Yeah. Let's segue to Global Equity Plus. So you're you're a third of the three amigos. The three amigos are who the sales team fondly refer to. So Dan Dupont, Mark Schmale, Hugo Lavallee. As Dave mentioned in his opening comments, we launched Global Equity Plus. Last October, it's already over $2 billion. We've seen incredible flows. And I think that's testament to everyone's excitement that we're able to buy yourself, Mark, and Hugo in a one-ticket solution. And so I think the great thing about Global Equity Plus as well is that if someone wants exposure to your long-short strategy, they can do it in Global Equity Plus as opposed to just buying it as a standalone. So maybe just tell me how you think about Global Equity Plus and how it's been fun to work with so closely with your good friends.
I think we're pretty good friends. I think Global Equity Plus is a really great home for global value long short, if not the best home. It's exactly where it should be inside of that portfolio of 4 funds, which is basically right now at least negative beta, negative volatility to the market. I'm not saying it's going to stay there all the time, but as long as I see a lot of opportunities that are volatile on the short side, it's going to protect us when the market corrects. It's great to be aligned with Mark and Hugo, who have very different styles of investing, and so I think together it's a really good combo. And Global Value Long Short is objectively, a very interesting product to put inside of a diversified portfolio funds for your clients, but it's much easier to own inside of Global Equity Plus because it's kind of hidden in there. You don't see that line every day like, oh my God, market's up again and Dan's down again. I mean, it'll be the opposite at some point, hopefully. But yeah, I think it's a great home. I really, I love that product, and it makes the flows much more slow and steady in global value long short, which I really like. So hopefully that fund grows a lot and it becomes, the biggest part of the assets inside of global value long short.
And just for everyone in the audience, that Dave also mentioned it earlier, but we will be launching the strategy in a balanced mandate. So we're always listening to advisor feedback, and there was a lot of demand for the strategy in a balanced mandate. So that's coming in May. So we'll look forward to that. How have you, from a process standpoint, how have you just consistently been able to deliver that downside, given that the market is constantly changing and evolving?
Well, frankly, from my perspective, from my chair, I would have loved if there had been at least 1 or 2 recessions in those years. I mean, I've been managing money since January 1st, 2009. I haven't seen a recession yet. I'm here trying to protect people's capital every single day, every week, every month, every quarter. And then, we have a whiff of maybe, something a bit more volatile for about 3 weeks in March of 2020. And, the Fed comes in and we don't have a credit cycle. So I'd say, I hope I'm going to be here for a few decades more. I love this and I want to keep doing this. But I hope in those 20 years, I'm going to see at least 1 or 2 recessions or credit cycles where you get the opportunity to, show what you can do to protect capital a little bit better. Because, it was fun, March of 2020, to deploy all the cash and all the liquidity I had and sell all the arbitrage and go into stocks. But, it lasted about 3 weeks and off to the races as we go. So hopefully there's a bit more volatility. And if there isn't, well, great. You have Global Equity Plus and, we're going to do okay. But I'd love to see more volatility in the next few years and decade plus. So I'd say it wasn't that difficult. I mean, our sales team doesn't like it when I say this, but I wouldn't mind to have a down calendar year at some point. If it means the market's down 30 and I'm down 5, I'd love that. It's not by design that large cap doesn't have a calendar down year.
We kind of had that in 2022.
Yeah, a few things came together, and so it was a pretty good market for me. I mean, we're not shooting to not have a down year. I mean, I'm trying to maximize returns while minimizing downside, trying to beat the market over the medium term by several percentage points. If we can protect really, really well, I mean, that's kind of the holy grail, right? So, but there's all kinds of things you can do. I've obviously been involved in arbitrage for a long, long time, since December of 2007, my first arbitrage deal. And there's all kinds of little things you can do. I think a lot about currency exposure as well. If I invest in Brazil, I'll think about the currency impact there because the currency is as impactful as the underlying stock. And so all these things, they come together in my head, and it's really a way of investing for me. Everything kind of comes together in the sense that I'm really trying to minimize the volatility and the downside, such that every little basis point from every angle counts. So arbitrage really counted in February of 2020, and then being fully invested in areas that were cheap. So oil was really impactful in the fall. So you just slowly move to where the cheapness is. You always look a bit stupid. I bought a very out of favor stock in December and went to our little holiday dinner, and before even saying hi, there's a trader that asked me, "Why in the world are you buying that stock?" I mean, that's kind of the reaction I want. It means I'm probably onto something here.
That person's brave.
Well, I mean, they just couldn't see the angle, right? And which maybe I'm not that smart, so maybe there was no angle.
Were you right?
Sorry?
Were you right?
Very correct. But I mean, that's just one example. I'm just saying that's the reaction I want. Could have been wrong.
Last 2 minutes here. So I just always like to ask people a personal question about themselves, a gift to the audience. So if you can maybe share a book that you've read recently that you really enjoyed, or a book that you would recommend that people in the audience should read.
Well, what I'm reading right now is The Ego is the Enemy, which was recommended to me by a friend of a friend at dinner with, by chance, and he's a coach of a national soccer team at university level, and they won the national championship. He was explaining all these things, how we had to get people's mindsets in the right place, and he was just quoting that book again and again. So I'm reading that, almost done right now. So that's my current reading.
Great. I just want to say on a personal note, I spent many years on the road wholesaling. I talked about your funds a lot. And I think I'd just like to say thank you. And I think on behalf of the audience, just to say thank you and congratulations on a great career so far. And with that, I'm going to pass it over to Dave Bushnell.
Thank you for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. Thanks again. See you tomorrow. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.